Good afternoon, this is Chris. It's July the 11th, and welcome to our monthly Connect series for premium members. And want to wish all of you a happy summer, belated 4th of July. Hope that your time with your family and your summer is going extremely well. So let's go ahead and get started. Got several slides today, and here we go. As a reminder, we're not a bull or a bearish shop. We believe that being bullish or bearish is nothing more than a psychological state of mind, not a strategy. So we're really open to a lot of different things happening and excited about opportunities always. And as a reminder, the power of the patterns, your 28-second solution to investment research. We hope you can see the power of the pattern and see really quickly and efficiently and effectively why we feel a certain way, that we do about certain patterns. So let's get started with just general stock indices. A reminder, this is a piece that we started off with in the global dashboard. That on the left is the Dow monthly, and on the right is the S&P, where we've applied Fibonacci to the 2007 highs and the financial crisis lows of 2009, to where both of them hit the 161 extension levels, and just played around with the resistance level, which was about 18,000 on the Dow on the left chart, and the 2130 level roughly in the S&P on the right chart. But they continue to bump up against this resistance, was in a trading range for roughly about 15-18 months, and then broke above. Both of them did use old resistance as new support, and they both pushed nicely higher since this point at number one in each last fall. So they continue to really stretch out and push above or out of that sideways consolidation. This is a closer look at the same 161 level on the S&P. You'll notice that it's broke above it. This is SPY, so that the 161 level comes in about the 238 level on SPY. You'll notice that it broke above it, pushed off of it. And then this is essentially the last 6 weeks at number 3, which has been mostly a sideways chop with a continued series of lower highs, but not by a big percentage by any stretch. So mostly very narrow, choppy action taking place over the last 5 or 6 weeks. You can see here, still above the 238 level. It's bullish, obviously, staying above the 238 level. Some concerns would come up if it would take out that 161 level to the downside, the 161 extension level. Looking at the NASDAQ, which has been stronger for a good time in the broad market, but then it's actually been weaker for the last, say, 6 weeks. And you can see that the decline over the last 6 weeks has taken the NASDAQ to test rising support that started from roughly about a year ago. This is when Tesla, I know the NASDAQ is not one stock, but it's amazing how the NASDAQ seems to be highly influenced by what Tesla is doing. And Tesla last week came down and hit a support line, and ironically so did the NDX. You can see a small bullish wick, bullish reversal pattern right here at rising support and the horizontal support. Then we've seen a small rally on the NASDAQ. So the trend still remains up in the S&P and the Dow and the NASDAQ, obviously. But there's been some sideways to soft action, with tech being softer than the broad market over the last month and a half. As we step back and look at the advanced decline line from the New York Stock Exchange, this is the NYSE common stock only. We've discussed this before, but to me this is one of my favorite ways to look at the AD line that strips out any bond funds, closed-end funds, or any of the sort that are on the NYSE, so you can just see what the stock's underneath. When you lift up the hood, see what's going on underneath.
Hey, Chris.
You see, yes?
The slides are not moving. And I've had some people tell me that they can't see the slides, so I don't know if you need to click show my screen or something.
All right, well, we'll just start.
Now we're good. Now we're good. I don't know if you want to go back and start over. It's not that far into it, but up to you.
Yeah, thank you, everybody. I'll just start all over. We're just a couple of slides in. Thanks again for joining us. Today's July the 11th for our monthly, Connect series with premium members. As a reminder, we're not a bull or a bear. Being bullish or bearish is nothing more than a psychological state of mind, and so we're always excited about opportunities, but we're not trying to wear a bullish or bearish hat when we look at the power of the pattern. Again, the power of the pattern is your 28-second solution to investment research. We hope you can see the pattern at hand and the action that we feel that you want to take, and not have to read through 28 pages of research like a lot of reports we'll put in front of people just to come up with a single idea to buy or sell. So let's get started on the stock indices. As I had just shared, this is what we start off the global dashboard with. It's a big picture look at the Dow on the left and the S&P on the right, to where we applied the Fibonacci levels to the 2007 high and the 2009 low. They both ran into the 161 extension levels, traded sideways, just paddled water for almost a year and a half. Then once they pushed above the 161, from a clean perspective, what you like to see, it doesn't always have to happen. A breakout can happen, and any asset could break above a resistance line and never look back. But ideally, you like to see it break out and then come back and test old resistance as new support. Both of them did it at 1, and they both pushed cleanly higher. So the key levels for if the markets would get into some trouble would be 18,000 on the Dow on the left and 2130 on the S&P. This is a closer look at the S&P with the same Fibonacci level applied. You can see where it broke above this is the SPY, broke above the 238 level, and then over the last 6 weeks it's been sideways chop, most just a slight, what are we, 1 or 2% off the highs. No damage has really taken place. It's just mostly been spinning sideways, frustrating as far as just going nowhere. If all of us like to make money all the time, but there are times where it does consolidate and regurgitate for a while, and that's what it appears to be doing up there at 3. The NASDAQ has been stronger over the last several years, or since 2002 has been stronger than the S&P. Since 2009, again, it's been stronger than the S&P. But of late, which is a very short-term time period over the last 6 weeks, it's been softer than the broad market. The decline over the last few weeks took the NASDAQ to rising support and horizontal support at 1, where it created a bullish reversal wick last week. It hasn't proven anything, but that is a place that you would like to see that type of price action from a bullish perspective take place, being this reversal wick on support. We're just obviously a couple of days into the new week. You can see last week's action right here, and then this is this week. We were down earlier today, and there was some reversal that went on, and Tesla seems to have quite a bit of influence on what tech stocks do of late. Tesla, as it's been weak, so is a lot of the tech, and then as it reversed some today, tech kind of rallied along on its coattails. So this is the NYSE advanced decline line, and it's a common stock only. It's where you strip out all of the closed-end funds and bond funds and stuff, so you can really just get a look at what stocks are doing underneath. Very much a quality rising channel. One of the first things that you'd want to look for as we share this every week would be, first off, would be a divergence, which is not happening, but in the past we've seen divergences where the 80 line starts heading south before the broad market. Those are always concerning issues. At this time, we are not seeing this as a current AD line, and it is close to all-time highs inside this rising channel. If there would be any concerning messages, the first thing would be is that it would have to just break below this horizontal shelf, which it has not. But right now at this time, the AD line is sending a very positive message. So as we look for just other pieces, we lift up the hood and look underneath. I've enjoyed looking at junk bonds for a long time. They can tell a lot of good messages as far as looking for divergences. Being long stocks, you want to see junk heading up, and junk has been heading up since January of 2016. We have seen junk over the last roughly month as the market has chopped sideways and not made much net progress. Shouldn't be a surprise that that's what junk has been doing. Junk did hit resistance and has peeled back a little, and it's also broke above steep rising support. This is not a bearish message, but it is seeing a little bit of weakness. So being long a lot of positions, you'd like to see junk acting a little bit stronger than it is, but nothing alarming by any stretch at this time. Would be concerned if junk would head south, from here, obviously. Being any long positions that you have or being long the market, you'd like to see junk actually break above resistance at the 37.33 level and take out higher. So really small cautionary message. I didn't put it in the PowerPoint this month, but the equal weight ETF, which is RSP, that's the equal weight S&P 500. We divide it by the SPY each week and share it with you in the global dashboards. It has been diverging, against the broad market. And when you look at a lot of different indicators, it's one of the few things that have actually diverged in a negative way, but it's not something that is bearish at this moment. It's hard, it's maybe slightly concerning at the most, but it's a real stretch to see many negative price actions that are taking place at this time. This is just kind of a snapshot of the world. The top two rows are the states itself. S&P's in the upper left, Dow's in the middle, NASDAQ is on the right. You can see they both, or all three, remain inside the blue rising channels, which has started in 2009. Just really clean rising action continues to take place. The middle row is small caps, mid caps, and value aligned geometric. You can see that they all three, again, remain inside the rising channels off 2009 lows. Value aligned geometric continues to fool with the 1998 and 2008 highs and what 2014 highs, I believe. Right here, it is a fraction above it. But again, continuing positive action, even though it's been just a little choppy of late. The bottom row looks overseas as far as Germany in the lower left, France in the middle, and London in the lower right. Again, they're all moving up. We're going to dig into Germany and France in the following screens. But I just kind of want to see on a global basis, you still see this upward slant, uniformity of rising prices around the world. This, I won't yawn here, but as you can see, this guy is yawning, but it just kind of reminded me of since our last Connect Series webinar. I just looked at the Dow, the NASDAQ, and the S&P and the Russell over the last 30 days, and I think there's an appropriate symbol up here of this guy yawning because it's just been really boring. We're seeing very little price action in either direction. I'm not a doctor, but if this is, it kind of looks like an EKG, just mostly staying sideways, moving up and down, with the biggest gainer in the last 30 days being the Dow at a positive whopping 1% and small caps down 0.88 with the NASDAQ and the S&P in between. But it also applies to this chart, which is the same indices, but just going back another 30 days. So this is a 60-day outlook, or look back, excuse me. The Dow is the huge winner, up 2.5% in 2 months. The S&P is up 1.3% in the black. The NASDAQ and Russell they're up between 1.27 and 84 basis points. So again, you could mostly see a lot of sideways choppy action going on. Doesn't mean negative things are taking place, but it constrains just a lot of opportunities. This will end. Generally, the longer that something goes sideways, the greater the breakout or breakdown. So we'll probably get treated to something really nice, an opportunity and standard deviation volatility coming out of this. It's above my pay grade to know when that'll take place, other than it's just been really narrow. We want to know where the parameters of the highs and lows are to be very watchful of breakouts or breakdowns. But again, the guy yawning pretty much characterizes the last 30 to 60 days. One of the things that I think we want to watch really closely, as I said, we would look at the DAX and France in a lot closer basis. So this is the DAX chart just blown up individually. You can see since 2009 in the green shaded area, it really had a nice uniform rising channel. This is the 2015 high that we continue to highlight each week in the global dashboards, that it actually broke above the resistance, and now it's come back down to test old resistance as new support. So this next screen is just a much closer look at that, so you can see the price action. This is the DAX on a weekly basis. You can see where the 2015 high was at the top of the rising channel. Then you can see that it did break above it, and then it came down, So this is a weekly chart. So 3 weeks ago was this really large engulfing bearish pattern that took place 2 weeks after almost a doji star right in here. But it came back down and tested the old highs. Ideally, you'd like to test old highs that were resistance as new support. Last week was a narrow price action to where you see another potential doji star on a weekly basis. You know, we're just 2 days into it. But one thing that from a long or bullish perspective, the ideal price pattern is again kind of like what the S&P and Dow did in the early charts in the presentation. Broke above old resistance, and right now it's coming down to test old resistance as new support. So ideally would be this support holds and pushes higher to higher highs. The concern would come in is if the 2015 highs are taken out to the downside. So really important when you get up in the mornings, if you're in the States and you look over what Europe's doing, is really pay attention to roughly the 12,400 level in the DAX is a key level in my opinion. So this is a closer look at the CAC 40 from France, and here it's in this obviously clean rising channel. But again, here's the 2015 high similar to Germany, the DAX that we just looked at in the prior pages. You can see the rally off this last year broke above it, but this isn't quite as pretty. We're going to blow up in this next chart. So this is the 2015 high on the left. You can see that the France tried to break above it, and it actually then 2 weeks ago another big move to the downside, but it did test rising support, and so far it's held. It would be concerning. Concerns would come out of Europe if both Germany and France would take out the 2015 highs and take out this support. They have not at this time, but I think this is really important to a lot of price action in the States by what we see in these two key indexes. And as you know, we continue to update these week after week in the global dashboard because we feel that they're really that important. One of the things that I think are really important, we've heard of the Dow theory that you'd like to see the Dow and transportation's doing well together. So the Dow is really close to all-time highs, and this is the transportation ETF on the left, which is IYT, and you can see in its choppy action from a few months ago, it actually was weaker than the broad market for a while, but now it's making a push to try to come back and get above weekly closing highs. And then this week, this would be a daily turnaround right here. You can see that's trying to break above that level. And at the same time that the banks or the financial ETF, XLF, is testing a similar pattern to what we see on the left. So for the broad market to continue to do well, obviously transportations are a very important ingredient in the States as well as financial, the banks. So both of them have similar patterns, and if they can both continue to break out here, which would be almost like a break of a double top or a short-term double top, that would be very positive price action if that takes place. Obviously, it would be concerning if both of these would fail and break back below those green lines, which were the prior highs. So I wanted to kind of update you that I think these are two that we really want to watch closely for confirming messages for higher prices. So from a perspective of, as President Trump got into office, and we discussed many times about the reflation theme or lack thereof, kind of wanted to go in on a little update of this. So the blue chart is the copper-gold ratio, and typically when the economy is expanding, you see that ratio heading higher, copper being stronger than gold, and when the economy is weak, you see it falling, meaning reflecting, that copper is weaker than gold. And then the bottom in the red is the yield on the 10-year note. And you can see there's a high correlation between the two. Patterns look a lot alike, but from the reason I shaded this pink in 2014, you see both peaked and they continue to head south, reflecting either deflation, disinflation, lack of growth, pick your term. But then prior to the election, you can see in the middle of last year, almost 1 year ago, they both started turning up. The copper-gold ratio started turning up, and so did yields. And yields really blasted off. This is when we shorted bonds 1 year ago this past month, and rates shot up, bonds got hit very hard, and we owned TBF. But then you'll notice essentially around Thanksgiving, as the theme of reflation and all the talk really started cranking up, and adjust your portfolios for all of that as society became convinced of it, all of a sudden these things started heading back south, and those plays that were associated with the reflation theme really started stinking it up and falling in price. So I don't know if you've noticed, and I should have done this before the webinar, and I apologize, but all of us can go on Google Trends, and you could put in reflation and look at the headlines or lack thereof of any given topic. But it's kind of interesting that after almost 6 months of these tools going south, reflecting a lack of reflation, and all of a sudden people started now in the media throwing in the towel that, oh, the reflation's over with and it can't come back. All of a sudden we're seeing both of these taking off and moving higher. Watching these closely is part of the reason that I own Freeport Mac brand. It's part of the reason that I own IYM, which is Basic Materials. Part of the reason to own banks. Banks typically can do a little bit better in a rising interest rate environment. So nothing has been proven, but you can see that a big test is going on, a series of lower highs in the copper gold ratio right here. So if this would break out, I would suspect that we start hearing a little bit more about the reflation theme, and whether we do or don't hear about it's irrelevant. It's just a lot of talk in the media. But from a price action perspective, this could be a good thing for some of the positions that we own. So a big test of that overall theme, if both of these would run out of gas here, it would just suggest it was nothing more than a counter trend, rally in this reflation theme and heading south. So a big test for both of these. For the most part, for the last 6 months, they've both been falling. We've seen a really sharp rise over the last 3 weeks, and now we've got a test of resistance. Here's another piece that is the inflation indicator or a growth indicator that I like to share frequently, and it's taking the treasury indexed ETF, the TIP, dividing it by TLT to create a ratio, and you can see that it's mostly been a deflationary trend being projected by this ratio in the pink falling channel. You can see earlier this year, first part of this year, it hit falling resistance, stopped on a dime, and also horizontal the prior high of 2015, and then it's been heading south. Right in here is where we picked up FCX and the IYM trade to see if that could work out, and then we're seeing this counter trend rally taking place. So the long-term trend obviously is down in this. Even the 6-month trend is down. A 3-week rally does not break the trend, but we are seeing a counter trend rally taking place with some decent strength starting at 2 over the last few weeks. So it's going to be important. I didn't draw a falling resistance line in, but it would be similar to the line that we looked at in the copper gold ratio. So I wanted to turn to interest rates and share with you a chart that we looked at last month. And this is the yield on the 10-year note going back, a quarter of a century. But the thing that kind of stuck out to me is obviously we're in a downtrend. This is where we shorted or long yields and shorted bonds last year. And then this is where we tried to pick up some bonds. We bought AGG 6 months ago, late December. As TLT was up here and momentum was obviously extremely lofty. One of the higher levels over the last 25 years took place just 6 months ago up here. The thing I wanted to just kind of take notice is as rates were skyrocketing from last summer going up, you'll notice this gap in the chart on a weekly basis. And when you look back on this chart, we can cheat looking back, there's very few times that you see this type of a gap on the chart. And a lot of people in the charting business say that a gap will become filled sometime, and nobody knows when. For sure I don't, but I have seen many times. I just kind of wanted to share with you that this whole rally, this is just a blow up of what's below, but you can see that unfilled gap. And so this was the chart we shared last month, and then now here's the update of the chart. And I'd shared with a few people that are members that really have have a lot of big positions in bonds for their practices and different things. And I shared that, for being long bonds or short yields, the thing that you would not want to see is the gap being filled and then a reversal take place. And we've actually seen that. And so it's hard to see, but this is a 3-week rally in yields. But it always amazes me. I don't know in the long term, humbly, what that's going to mean, but it amazes me to see this gap being created, and it stops and fills that gap just right on a dime and reverses. But from a 30,000-foot view, this is still a 25-year chart that the overall trend in yields is still down. Where yields get into trouble is, to me, is if this resistance line at the top of the channel would break. That's been in place for a quarter of a century. You can see resistance was hit here and they peeled down, and now we're making a little counter trend rally. This rally in yields has been hard on the bond positions that anybody has owned and what I own. So I'm very concerned to see if yields would break out. We'd have to be selling any long bond positions. Here's a closer look at TLT. You can see that TLT potentially on a short-term basis made a double bottom here, and then we saw a rally. The rally took place inside this rising channel, and then it hit resistance. This is a weekly chart, so you can see this was 3 weeks back that it ran right into here, and it's fallen hard, and now it's testing a key support line. So if this support would give way, if we see commodities do well, which could be concerning to obviously to bonds, we'll be looking at reducing any long positions in bonds if we see a breakdown right in this range. So a little concerning, and obviously a big test, as the trend over the last year, you can see, is obviously been lower. One just a reminder that the old adage of sell in May and go away in stocks. If you do the reverse in bonds, you can see that you actually historically want to be a buyer. This is a seasonality chart on the last 5, 10, and 20 years, the different colors, but you can see the majority of the time from mid-June on, rates rally through the year end. This doesn't mean that it has to, but I just want to keep you informed that historically from mid-June to the 1st of July through October for the next 4 or 5 months is historically higher for bonds, lower for yields. And this potentially could have a fit. This is the bullish-bearish ratio for TLT itself. And you can see at the time that we did the last webinar, when TLT was doing well, the percentage of people that were bullish TLT was fairly high. It was almost 80%. And now the 3-week decline that's taken place in TLT has impacted the sentiment, feelings or opinions on the owners of TLT, as we just saw just recently bulls change from 80% bulls to under 20% here just recently. And so this is a current chart of July the 10th from Sentiment Trader. Thanks to them for sharing this. You can see that overall bonds are historically closer to a low than a high when we see sentiment in these lower digits towards the 20-30 range. So obviously not too many bulls on the bond side of the fence after the last few weeks. This is an update on the stock bond ratio. This is taking SPY and dividing it by ZROZ, which is the PIMCO, the 30-year, 20-year zero coupon bond ETF. It doesn't pay any interest. So the reason I like looking at this is one of the most volatile bond ETFs that we can look at. It has a higher standard deviation than TLT in both ways. So it's kind of interesting to me that the ratio in 2014 peaked earlier this year. The same level was hit at 1, and so then we saw bonds rally, and so that caused this ratio to head south. And then here 3 weeks ago, as yields started moving higher, you see that the ratio rallied up. So we're testing resistance right now. So being long stocks to the degree that we are, we'd like to see this ratio actually heading higher and not breaking down at that time. If this ratio would break below dual support at 2, it would definitely send a cautionary message to long positions in stocks. Just real quickly, we're just at a point in our lives that valuations may not, it would be okay for any of you to say, Chris, why are you showing valuations when we're trying to do technical analysis? Would be a legitimate point. I don't think it's wrong to do or to remind ourselves, you know, of where we are. This is my 37th year in the business, and being schooled by John Templeton and fundamentals, it's just, you cut my arm and I'm going to bleed some of this stuff, and I don't think it's wrong to do. But this is a composite of 4 different valuation methods. This is from Doug Short. You can see this and get it for free at dport.com from any time. But it's just kind of a reminder, this is what, looking at 125 years worth of valuations. And other than the late 1990s, you can see that the majority of these valuations are at least as high or higher than the 2008 peak. The stocks peaked in 1965 and didn't go anywhere for 15 years. We're higher than those valuations. Don't have to tell you what happened in 1929. Excuse me, that most evaluations are just as high or higher than 1929. So this doesn't mean that the world's coming to an end, a bear market starts tomorrow, you got to get out of your long positions, or that it can't rally up. It doesn't mean any of those things. But I think it's really smart or inefficient for us to be aware of this, you know, that no long-term bull market in the history of America has started with valuations at these levels. I've said this before and I'll say it again, but it doesn't mean that the current trend has to stop. So someday, you know, this will be a game of musical chairs, and a few chairs will be jerked out, and you'll want to know where the door is, you know, to the outside. So I'm just sharing these from a perspective of long-term valuations that I think we can't totally overlook. This is the Buffett indicator, which is taking corporate equity valuations and dividing it by GDP, just for another way of looking at valuations. And you can see where the market was in the 60s prior to going nowhere for 15 years. This is where the market was in 2000. So you can see that we're not as high as 2000. From this perspective, the Buffett indicator, the market is higher than 2008. And it's essentially right at the same levels of where it was in 2015. So again, most bull markets haven't started with the Buffett indicator at these lofty levels, but it doesn't mean that the market has to peak, you know, here either. But again, it's an empowerment chart that I feel like everybody should be aware of. This is a look at just a momentum filter that's nothing more than taking, you can see at the bottom the disclosure of what this is. This is taking 12-month momentum and then dividing it by the 4-week average of momentum, and you're creating this oscillator. And so when the 4-week momentum crosses below the 12-month momentum, it would give a sell signal to move slow money from long to cash. And this is why the line would just go flat for a while. The patient didn't die. If it was an EKG, this wouldn't be good. But this is just representative of when the system had said to go to cash. And so I just kind of wanted to share with you, this is what, a 20-some year chart going back into the 1990s. There's been very few sell signals. This is something that we have working in the background that we don't put into the weekly reports, you know, that frequently. But you can see that, you know, right now this indicator is not very close to a sell signal by any stretch. But you can see it in the upper right of the chart that if you'd invested $100,000 in the early 90s, this is where the S&P would be, which is roughly 850,000. And then using the filter as a tool to step aside by avoiding these losses. So a good tool that we will continue to share, and obviously if we see it getting closer to a sell signal, we'll really be ramping this out and discussing it more. But at this time, the momentum is still to the plus side. So another thing that we hear talked about a lot, don't take this as a busy chart because it's really not, but the blue is the S&P and the red is the margin debt, but actually inverted to show, because what we're looking for is spreads between the two. And what I did this month is you can see that there was a large spread in 2000, and we'll see it in the following slide in the filter, but in and of itself, high margin debt is not a problem or does not mean that stocks have to peak out just because margin debt is high. Margin debt can be at a new record month after month after month, and stocks can keep going higher. The point is it's when margin debt is at a record level, but then it starts reversing itself. So in this inverted chart, again from D short, it's right here is when margin debt, again this is inverted, so this is when margin debt started contracting. But this is where you'd be concerned. This was in 2000, and you can see in 2008 when margin debt started going up in this inverted chart, that was the time to be concerned. And so margin debt at this point in time, this is released from the Fed once a month, so this is only a once a month chart that anybody can produce because the data is just monthly. You can see that the margin debt is at all-time highs. When it's inverted, obviously it's at all-time lows, but where the concern would just be is if it would start heading higher. And so it has not broken any falling resistance lines at 2, similar to 1. If this would happen, obviously we'll be in touch. But here's a similar filter to try to prove the case that what this does is that the year-over-year change in the margin debt, that when it crosses below 0, it suggests to take the long, slow monies and convert them to cash. So here you have these flat lines again. So you see a few more flat lines or a few more sell signals, excuse me, than the prior filter, but there's still only been, what, 1, 2, 3, a little one, 4, 5, 6 different times that it's suggested to go to cash in the last quarter century. And even though a couple of times it probably could have been more accurate, right in here, it was unnecessary to go to cash, you can still see that the using the margin debt as your filter or a guidepost is worth a good bit more than the S&P is itself. So we have these different filters going, running in the background for you guys as members. We'll continue to obviously really bring them forward if any of these will start bringing some concerning messages. We have a couple of more filters that I haven't shared that are not going to be private over time, but they are right now, but they're not sending any concerning messages themselves either. So this is just another sentiment piece from CNN, the fear-greed proxy. I thought was just kind of interesting that over the last several years, sentiment right now, from the way their tools, and again, this is available on several different websites for free if anyone wants to go find this. It is out there, everybody. But it's about at the mid-range. So despite a lot of talk on TV and the percentage of people bullish or bearish, you can see that from the CNN's gauge, we're just in the middle of the road. And that's probably why that guy was yawning earlier, and the market's going nowhere. We don't have any extremes in play right now. Excuse me. So moving on to the metal sector, just kind of wanted to share, this is an update on the US dollar gold ratio. So what this would reflect is when it is falling, obviously the dollar is weaker than gold, and that's bullish for metals. This was 2001. This is 2011, and so for 10 years, the ratio fell. Gold, silver, and miners just had a real heyday. It was really good. The heyday has come to a 6-year halt. It hasn't come to a halt permanently by any stretch, but it's definitely, if you've been buy and hold long metals since 2011, it's been a frustrating 6 years. So to be long metals and for metals to do well, you want and need this support line to break. What you don't want to see is this support line that has been in place for 6 or 7 years to hold and for this to rally, because if it does, it would reflect that the dollar is stronger than gold, and so money would most likely not be made by owning gold, silver, or the metals miners, gold and silver miners. So this is a monthly chart. You can see a reversal wick here a couple of months ago, and then a small rally. So as this rally is taking place, we can see that particularly like silver, they've gotten hit pretty hard, of late. So it's not a surprise. So we're going to continue to update all of you, and the metals members get to see this chart each week. Now the next chart that we're going to see, if I can get it to turn, is the exact opposite. This is gold dollar. So if you're long metals, you want to see this ratio heading higher, which would reflect that gold is stronger than the dollar. And it was, again, from 2001 to 2011. But it's continued to create a series of lower highs for the last 6 years, just below line 2. And again, this is a monthly chart, so you can, hard to see right in there, but last month it hit falling resistance, turned around, created a bearish wick. We saw in the prior chart it was a bullish wick at support. This is a bearish wick at resistance. And then so far, obviously we're not very far into the month of July, but it's attempting to go lower and break support at 3. So these are things that I find discouraging to be long the general metals, or should I say, I really need to define this a little bit differently, apologize, between precious metals and industrial metals, because we're going to look at copper and FCX here shortly that has a little bit of a different look. But from a precious perspective, this price action right now is not bullish. If it would take out the resistance at 3, all of these lines at 3, it would be one of the better messages that the metals complex has seen in years. So again, this is a big test of the 800-pound resistance line. Here's the silver-gold ratio that I've used since I was a financial planner, as far as it being important to whether you want to own the metals, being long or short. To be long the metal space, you want this ratio going up. You can see since, again, 2011, it's traded in the falling channel 1, the pink shaded channel. It hit a few months ago. It continued really since last summer. It just keeps banging on that resistance line, and then when it failed to get above it, it really has sank quickly over the last few months, reflecting that silver is much weaker than gold, and it's been painful for people that have been long that space. So again, no bullish messages coming from the gold-dollar ratios, the dollar-gold ratio, or the silver-gold ratio at this time. One thing that looks a little bit differently, it's not really that pretty from a bullish perspective, but this is copper. This is copper futures on a weekly basis going back the last, 4 or 5 years. No doubt it's in a downtrend, continues to create lower highs, and is now testing resistance again at 3. There was a little bit of support that was found right in here, and that's where we picked up FCX, trying to see if it could be a good possibility. So really key to the reflation mantra that's out there, some potentially global growth. I will be the first to say that although DOC copper has been weak since 2011, it hasn't stopped stocks from going up. So DOC copper may not have all of its importance of value, but I do believe that if resistance would be taken out at 3, I wouldn't be surprised to see bonds sell off more, because as copper has rallied right in here the last few weeks, yields have went up and bond prices have went down. So a key test for JJC, copper, and FCX being Freeport. Here's an example of the difference between precious and industrial, or between GDX and Freeport. This is a chart since the purchase of FCX. This is FCX in the dark and GDX in the orange. And this is a 6-week chart, somewhere in that range, but you can see that FCX is up close to 700 basis points with GDX close down to 6. So that's almost a 13% or a 1,300 basis point spread. This is quite a fish mouth that's going on. So this is why I've tried to avoid the miners, other than we did trade them a couple of times this year successfully. We traded them one time with a small loss, but since we bought our first position in GDXJ a couple of days after Christmas, we do have some really nice gains so far for this year in the mining sector, even though we've owned them for not very long this year. And if you had bought and hold from January 1st, it's been very unimpressive. But so I am impressed with the difference that all miners are not the same. That's essentially why I wanted to show you this chart, that you can own a gold mining stock and a copper mining stock and see a really different result. Something that's I'm keeping my eye on, this is the Aussie dollar. The Aussie dollar has because of the natural resource richness of its country, of Australia, what the currency does seems to have a very high correlation to commodities. We talked earlier how commodities peaked in 2011. You can see the Aussie did the same thing. It didn't start heading south as fast as metals, did, but it has obviously drifted from to, I don't know what, 25% decline over the last few years. Pretty good size decline for a currency. But the thing that's catching my eye is we see rising bottoms off 2001. This is right where the metals rally started in 2001. We see some support being hit here, and that's where gold and silver were closest to their lows with counter trend rallies over the last almost 2 years. But there's a chance that there's obviously it's above support, but this is potentially a bullish ascending triangle. And if we would see a breakout at 1, that would send a positive message to the commodity space. Most likely Freeport would like it, copper would like it, and I would be surprised if metals didn't like it as well. So a big test for the Aussie dollar to try to, to get above this resistance in, roughly the 80, 79, 7, let's just call it 78. A close above 78 on a weekly basis would be a positive signal from the Aussie dollar. So don't take your eye off of that. If you're not watching the currency markets a lot, put in your system that you're watching to watch FXA. That's the Aussie dollar ETF. To see how it's doing. This is just a reminder of the silver-gold ratio over the last 30 years. That you can see it several times. It's traded in these red falling channels, but when we would see a breakout in any of these, that would be reflected that silver is stronger than gold. But both silver and gold have typically rallied on these breakouts, and so it had a test a few months ago, a chance to break out, and as it has been for the last 6 years, the ratio let the trend remained the same, and it let the metals bulls down, but it failed to break out and has dropped rather precipitously over the last few weeks. So I'm glad to not be long that space. High five to any of you that have been shorting this. We've talked about it a few times, and I didn't pull the trigger, but on the opportunity to short silver, and silver has been pretty weak of late. So I didn't draw a band in here, but if you would just imagine a horizontal line, if we'd come right through here, that you'd see that many of the times the ratio has hit a bottom in 1996, 2003, 2008, early last year when the ratio was getting close to this zone. So it's narrowing in on a zone where we've seen some rallies take place almost every time over the last 20 years. So the weakness of late is getting close to a key support test. So moving on to the energy space, I wanted to, and we're going to discuss some other commodities right in here. I found this just out there on the web, and it intrigued me, but this was a roughly, 45-year chart dividing commodities by the S&P, and just trying to not use it as a timing tool, everyone, but just as a perspective tool to empower us on extremes. And so you can see that in 1971, right here, the ratio obviously was very low and turned higher. I will say this was back, for some of you, probably when you weren't born. We do have a lot of premium members that are my age. Will be 60 next month. But when this ratio took off to the upside, right in here, left roughly in 73, that's when we had, this label of the oil crisis. And what was not put on this chart is that was also when the President Nixon was impeached, at the time. So the S&P fell over 40%, closer to 50%, actually. So the next time this ratio was down here was in the late 90s. And for most of you, then you don't have to be that age to know that the market did suffer another 50% decline in roughly starting in 2000 when the ratio was here. So all of a sudden Chris has mentioned 50% declines and it's down here again. Does that mean he's suggesting another 50% decline? The answer to it's no. That's not the point of this. This is a point to get some perspective in the long terms. When you see markets that have just done terrible year after year after year, it's pretty easy to dismiss them, that this isn't the time of our lives to invest in them, and it still may not be the time of our lives to invest in commodities. But this ratio is really way out of whack. We see the very opposite of this ratio in 2008 or 9, that would have been a good place at the end of the financial crisis to come in here and be a buyer of stocks in this time frame. And same here if you've been a buyer roughly 91, 92 of stocks, it would have treated you pretty well for just the next 8 years, a couple 100% rally. So not a timing tool, just for perspective of everyone, that this thing is really at some extremes. This chart that we're looking at is stock and commodity ETFs. This is what we put in the sectors report each week. We just kind of wanted to share the criteria that we did some search on is actually the right-hand column, the 3-year returns. Rick does a great job helping me with this every week, and so this is the 2 and the 3 year, but I'd really like to have you focus on this 3-year column. Why is the red horizontal line in here? This is the dividing line between plus and minus on a 3-year basis. So these are all assets, and obviously the deeper that it goes, the redder that it gets. I know that's not a word, but the bigger the losses become. And so from a long-term perspective is, like 3 years from now, do you think that these are the things to own for the next 3 years? If you could just put $1 in an envelope, would you rather put it up here or would you rather put it down here? So we're not going to dig into all these charts, but I just wanted you to see this, to kind of still have that long-term perspective of what's been hot over a few years. Hot can remain hot and cold can remain cold, but somewhere along the line some of these trends could reverse. And so some of these from the energy sector, obviously, and sugar and coffee, we've been covering that, and the grains, they just really stunk it up over the last few years. But in time, I really believe, friends, that this will end up becoming an opportunity. So I just kind of wanted to share this big picture perspective of performance, particularly on a 3-year basis, of what stuff intrigues me for potential reversals in time. Not necessarily the next week or next month or even between now and Christmas, but just from a larger term perspective. I think there will be some long-term opportunities here. And humbly, I have to say, if these aren't long-term opportunities and they continue south, I think we've got there's obviously some deflation taking place. So crude oil, which we all know is hugely important on a global front. Even many countries use crude in a form of a currency. The longer-term trend from really clear back in 2008 is down, because we see a series of lower highs, and then we saw the sharp decline. Obviously, it started late in 2014, but as we look over the last year or so, it's been pretty narrow, choppy action. This is $70, $60, $50, right in here. You can see that roughly 55 was a high earlier this year. We've been sharing this falling resistance line with you, that we thought it was a really tough piece to get through. For quite a while, we discussed that this could be a left shoulder, a head, and a right shoulder, and this could be the form of a neckline. The pattern is not bust, but to me, it's kind of morphed out of some of its influence, because it hasn't influenced crude to really break out of this potential neckline up here. So now it's back to the levels of almost what the perceived right shoulder could be. So narrowing pennant patterns taking place. You can see the lower 40s. Roughly about a month ago, it came down here and hit support, and it's had a little bit of choppy action. So someday crude's going to break out of this, but obviously this key component has been soft. It's been nice. Obviously, all of us on this phone call are from many places in the States and all over the world. We're still paying back here in Kansas, close to $2 a gallon, and it's kind of nice when you fill it up that it's been cheap. But obviously, this has influenced UGA, which is the gas ETF, in a negative way. It's not doing well. XLE, the energy stocks of the 9 sectors, inside the S&P 500, obviously energy stocks are the weakest. XOP, the drillers and exploration stocks, they've also been weak. But somewhere along the line, if the world doesn't become too awash in oil, these energy stocks intrigue me from potential support and participating so poorly for several years. This is the one chart from a long-term perspective that we first started really banging I'm just going to do it right now, but beat the table. But 3 years ago this month, July 2014, we shared that this could be, in total hindsight, still I believe it's the largest head and shoulders topping pattern I could find in any asset. And we were sharing in July of 2014 that if the read was right, the right shoulder was in play, and that commodities could really, be hit hard, and obviously they have, so that's the past. But if you look at these outer blue lines, that since the mid-80s, this index has spent roughly 99% of its time in this rising channel. And this was the oil low. This is on a monthly basis. You see this reversal wick taking place that was almost at the same lows as the financial crisis. We've seen a counter trend rally. It made a short-term double top. This was the 23% retracement of this huge drop in commodities. Counter trend rally, ran out of steam, and it's come back. Now last month, as oil was hitting the bottom of that pennant pattern, you can see a little reversal wick trying to come into play in crude oil right here. It's a pretty good size one. Or that's when crude oil had a reversal, and you also see somewhat of a good size reversal in the Thomson Reuters commodity index. And this is an equal weight commodity index. The majority of my 37-year career, the CRB index was influenced highly because it was overweighted by crude. They're trying to make this a little bit more of a balanced ETF or index, itself. But again, this is a huge rising support test that it's in play. And I really believe that for the world to reflate and grow, you need to see this support line hold. And if the support line does break, I believe we're going to see just more disinflation or disinflationary prices in the commodity space. So big tests going on because, again, this is a 35-year support test. So just a quick look at our positions. We're sending the positions out to you now twice a week so you can see where we are. I believe that we sent this sheet to you, so I won't go through it in depth. You got this update, today. You can see the numerous positions, that we have. I will say, because my goal that I'm doing with the portfolios, I'm trying to have 10 positions representing 10% each. So 10 positions at full 10% would be your 100% portfolio right there. But what you've seen me start doing is, because of a few of these long positions, several ascending triangles that are taking place, I'm actually going to try to take the half position so I could expand the portfolio and just have potentially a little bit more diversification. But we do have a good deal of exposure heavily of a couple of sectors. When you think of MCK, McKesson, you see the XLV, the healthcare, and IBB. Obviously, those are three different pieces of one key segment. We also see FCX, which is Freeport, and you see IYM, which is basic materials. They're going to have a similar influence, that if we see some growth. So this is not really a highly diversified portfolio. It's a little bit more concentrated, and then a few different positions in similar sectors. And so essentially, if MCK is to continue to make money, I would expect the healthcare to do well, and potentially IBB. So we'll probably either be really right with these multiple positions in one sector, or really wrong. There probably won't be too much in between. So just a quick look on some of the older positions that we have, because we keep updating the new ones each week for you to kind of where we are, or on a more regular basis. Financials were bought essentially a year ago, and they were bought here as we started seeing a series of higher lows, and this looked to be an ascending triangle taking place. If you can imagine, I didn't draw it in, but a flat top and rising bottoms. It was narrowing, so I took a position in this. This was before the election by a few months. Then you saw it take off, and we continued to sell into strength. And This was February or March. I'm sorry, I can't exactly tell by the bottom of the chart, but we sold into the strength, and then you can see it's pretty much just chopped sideways. But now it'd be a positive. This is obviously a double top test. But if we would see a breakout here, it would be obviously good for, should be good for XLF, and should be good for owning Citi. And also on the flip side, we would not want this to be a double top. You know, the trend is up, a big test, but if banks would break out here, it obviously would be good for that sector and should be somewhat positive for the broad market as well. Also going back on an older position, this was the bond position of AGG that was taken just before the start of the year. So we got in at a good point, it rallied, and then it gave all of that rally, you know, back, potential double bottom. Then we've seen the rally in AGG up, and then it hit falling resistance about the same time. If you remember at the start of the webinar, we discussed the 10-year yield and the copper gold ratio, and about the time that those started heading higher, this was hitting resistance. So in some ways I was creating a hedge against some bonds by taking some of these commodity positions. So bonds have backed off. You can see AGG is you know what, down 150 basis points, not too much. Or the reason I own AGG, it's a little bit of a more cautious way to play bonds. The yield is, none of the yields, as we all know, are high on bonds, but it's a little lower, but it has a shorter duration, a little bit more of a mix. AGG stands for aggregate, so it's a composite of different bonds and doesn't have quite the standard deviation that TLT does. Excuse me. This is a look at one of our older positions also in EFA. As you notice that the last several weeks, almost a month, we've tried to highlight bullish ascending triangles, and the reason again that I'm doing that in the sectors report is that in an uptrend, uptrending market, that's what we're still in at this time, I want to try to find those patterns that give us a 65% chance of an upside breakout, and this pattern also is very good about managing, you know, risk for us if we're wrong, because a third of the time the pattern is going to bust to the downside. But we bought EFA here several months ago, and it's been obviously rallied, and then we've sold into the rally, and then it's hit resistance and then, you know, backing off of late. Earlier we talked about that unfilled gap in what the 10-year yield. You also see another unfilled gap in EFA, you know, right up here, that being long I'd like not to see filled, but that's still hanging out there. But obviously resistance was hit, and it's been backing off almost for what, 5 or 6 weeks. Excuse me. Here's a longer look at McKesson that we own. Again, another bullish ascending triangle is purchased back here. We've sold some of it into strength and been raising our stops. So key resistance is still in play at 4. If we keep this long-term trend in perspective, if resistance would be taken out at 4, it would have a lot of room to run. So we have sold some into strength. We've got our stop set not too far below this, but my game plan would be is if we could see MCK actually break out, I'll probably go back and buy some more. This is a look at Freeport-McMoRan, that when the copper gold ratio was low, and so with 10-year yields, looked to be a bullish ascending triangle forming. In FCX, it was obviously fallen, excuse me, a pretty large percentage, lost over a third of its value in a few months. We've seen it rallying out of this bullish ascending triangle. We've got, I don't know, 6% gain roughly, you know, on the position right now. Not a lot to brag about, but a big test of prior highs taking place this week at 2. So if it could take that out, it could rally up to almost the 14 level pretty quickly. So a big test of short-term resistance in the counter-trend rally for FCX. I like what I see so far, but to prove anything, it's got to get above this resistance at the 1243 level. Excuse me. Just a reminder, as we started in the month of July, these are the July seasonal strong stocks that have done well. Again, our criteria is to go back a decade, look for stocks in the S&P 500 only that have done well in any given month. And again, this is the month of July. So you can see the percentage of time that these stocks were higher. The market overall, 60% of the time, it's up in July with a median gain in the last decade of 1.72%. Obviously, that's a pretty good month when you consider that just from a round number, let's say that the S&P has averaged 10% for 100 years, and the actual returns are a little bit lower than that. But just from a round number, if the median gain is 1.72% in the month of July, you can see that almost 20% of the year's gains has historically taken place in the month of July over the past 10 years. So we're sure not seeing it so far this month, but I continue to, I have screens set up for all of these charts that have historically done well, and continue to watch them. Not a lot of breakouts that are taking place, but if they do, we'll sure let you know. But I wanted to continue to see what stocks have usually done well this month. So in wrapping up, I wanted to just look at a couple of different extremes. We all know what's been happening to retail. It's interesting that 3 weeks ago was the news of Amazon looking at buying Whole Foods, but the bottom line is from a retail, and as we all know, on that Friday, whether it was the Kroger grocery stores or the Walmarts and the Targets of the world, they all got hit pretty hard. But when you look at the 30,000 foot view from a bigger picture, you can see that retail didn't start going down on the news of Amazon buying Whole Foods. It's been going down for a couple of years. So big test in my opinion is taking place, because this is what a 4-year support line that's been hit several times, and it's in a downtrend. We could make a case for an awkward head and shoulders, or we can make the case of a descending triangle over here. Whether it is a head and shoulders or a descending triangle, those are both bearish. The bottom line is the trend is down for the last few years, and a big support test is in play. I suspect that many of you probably cringe at the idea of buying retail, understandably. Oops, I'm going to go back, sorry. I have not bought XRT, but this is a place to really be eyeballing it, because if a reversal is to take place, you can see that it did here in 16 and again in 14. So this is a very key level for this sector that's stinking it up. And I humbly don't know what it really means in the big picture. As I've driven around many cities, my wife and I, we always look around at brick and mortar and just say, I wonder how they survive. The stores aren't that full. And maybe here's a true picture of what's taking place. But again, a potential extreme is taking, and I didn't even draw it in, that we have another potentially bullish falling wedge right here. So the ideal price action that we'd want to see from retail would be a bullish reversal look at support here to consider buying, and I'll look at doing it if we can break above falling resistance. So on the flip side of a breakout of a potentially bullish ascending triangle is China. And we all know that that's a small populated country somewhere in the world, right? But this could be really important to even from the coppers, the Freeports, and the reflation theme. FCX or FXI, excuse me, looks to be forming a bullish ascending triangle. Broke above it and hit the 2015 highs here. Backed off. Hasn't really come completely down to that support, but so far this week is pushing higher and is back to testing the prior highs of a few weeks ago and also 2015. Now there's, going back to gaps, there's a large unfilled gap up here at the almost $45 level. So if we would see a breakout here, I would want to be an owner of FXI, because the next key resistance and a gap fill could come into place about 45. So $5 on 40 would be a little bit over a 10% gain. So we're watching China really closely here, the FXI. If we see a little bit of strength, I'd want to be a buyer on a breakout. So I've probably punished all of you enough today, but I want to thank you for your membership and your time listening to the ideas that I put together each month. I hope again, all of you are doing, very well, and wish you a great summer. And somewhere along the line, some of the sideways choppiness is going to come to an end. So anyway, I want to wish all of you the best, and thanks again. Take care, everyone.